Hey everyone and welcome back to the channel. It's the news we've all been waiting for. On October 30th, 2025, the Federal Reserve announced its second interest rate cut of the year. This is a huge development, and today we're going to break down exactly what it means for you and your investments. Whether you're in stocks, gold, or just holding cash, this decision is going to ripple through the entire global financial system. So, grab a coffee and let's dive deep into what this rate cut signals, how it might affect different markets, and most importantly, how you can position your portfolio to navigate these changing tides. First, let's understand why the Fed is doing this. A rate cut is essentially the central bank's way of hitting the gas pedal on the economy. By making it cheaper to borrow money, they're encouraging businesses to invest and expand, and consumers to spend. This second cut suggests the Fed might be seeing some signs of an economic slowdown that they want to get ahead of. They're not just tapping the brakes anymore. They're actively trying to inject more energy and confidence into the market. Think of it like this. If the first cut was a just-in-case measure, this second one says, okay, we're serious about preventing a downturn. This proactive stance tells us a lot about their outlook for the coming months. It's a signal that they prioritize growth and are willing to use their most powerful tool to support it. So, what does this mean for the stock market? Historically, rate cuts are like a shot of adrenaline for stocks. Lower interest rates mean borrowing costs for companies go down, which can boost their profits. This often leads to higher stock prices. We'll likely see a positive reaction, especially in growth sectors like technology and consumer discretionary stocks. These companies rely heavily on borrowing to fuel their expansion, so cheaper money is great news for them. However, it's not all sunshine and rainbows. A second rate cut can also make some investors nervous. They might ask, what does the Fed know that we don't? Is the economy weaker than it looks? This could introduce some volatility. So, while the initial reaction is often positive, we need to watch for underlying sentiment. Is this a celebration of cheap money, or a worry about the economy's health? The answer will determine the market's direction in the medium term. Now, let's talk about the US dollar. The relationship is pretty straightforward. When a country's central bank cuts interest rates, its currency tends to weaken. Why? Because lower rates mean lower returns for investors holding that currency in savings accounts or government bonds. International investors might look for better yields elsewhere, selling the US dollar to buy other currencies. This could be good news for US-based multinational corporations because a weaker dollar makes their products cheaper and more competitive abroad. It can boost their international sales and, in turn, their stock prices. For consumers, it means imported goods might get a bit more expensive. So, if you're planning an overseas trip or buying foreign products, you might feel the pinch. The key takeaway is that the dollar's status as the world's reserve currency gives it some stability. But we should expect a gradual downward trend against other major currencies. What about a classic safe haven asset, gold? Gold loves interest rate cuts. Unlike stocks or bonds, gold doesn't pay any interest or dividends. So, when interest rates are high, holding gold has an opportunity costs you missing out on the yield you could be earning elsewhere. But when rates are cut, that opportunity cost shrinks. Suddenly, holding a non-yielding asset like gold becomes much more attractive. Furthermore, as we just discussed, rate cuts tend to weaken the US dollar. Since gold is priced in dollars, a weaker dollar typically pushes the price of gold higher. It's a double win for gold investors. Add in the fact that rate cuts can sometimes stir up economic uncertainty, and you have a perfect recipe for a gold rally. Investors often flock to gold as a store of value when they worried about inflation or economic instability, and this Fed move ticks both of those boxes. So, the billion-dollar question: what should you, the investor, actually do? The first rule is, don't panic. Making sudden emotional decisions is rarely a good strategy. Instead, this is a great time to review your portfolio and your long-term goals. Does this new environment change your risk tolerance? For stock investors, this could be an opportunity to look at those growth and tech sectors that benefit from lower rates. Also, consider companies with strong international sales, as they'll get a boost from a weaker dollar. If you're more conservative, you might want to look at dividend-paying stocks, as their yields will look even more attractive now. For those looking for safety, This environment is clearly favorable for assets like gold. It might be a good time to ensure you have a small allocation to precious metals as a hedge against potential volatility and inflation. But remember, diversification is your best friend. Don't go all in on one asset class. A balanced portfolio is designed to weather exactly these kinds of shifts in the market. Let's also consider the bond market. The relationship here is inverse. When the Fed cuts rates, newly issued bonds will offer lower yields. This makes existing bonds with higher yields more valuable. So, if you're holding bonds that you bought before the rate cut, their price on the secondary market likely just went up. This is great news for bonds. However, if you're looking to buy bonds now, you'll have to accept lower returns. This is part of the Fed's plan to push investors out of the safety of bonds and into riskier assets like stocks to stimulate the economy. This shift creates what is known as the TINA effect. There is no alternative to stocks when bond yields are so low. While bonds still play a crucial role in a diversified portfolio for capital preservation, their income-generating power is definitely diminished in a rate-cutting cycle. This reinforces the need to think carefully about where you want to find growth in your portfolio. What about the real estate market? Lower interest rates are usually fantastic for housing. The Fed's rate doesn't directly control mortgage rates, but it heavily influences them. Cheaper mortgages mean lower monthly payments for home buyers, which can boost demand and push home prices up. If you're looking to buy a home or refinance your existing mortgage, this could be a golden window of opportunity. For real estate investors, lower borrowing costs can make new projects more profitable. However, we have to balance this with the reason for the rate cut in the first place. If the economy is genuinely slowing down, that could lead to job losses and reduced consumer confidence, which would eventually cool down the housing market, regardless of low rates. So, while the immediate impact is positive, the long-term health of the housing market will depend on the overall health of the economy. It's a delicate balance, so, to wrap everything up, the Fed's second rate cut is a major signal that they are committed to supporting economic growth. This is generally positive for growth stocks and assets like gold, but it puts downward pressure on the US dollar and bond yields. For the average investor, this isn't a signal to overhaul your entire strategy overnight. Instead, it's a prompt to review, rebalance, and ensure your portfolio is aligned with the new economic landscape. Focus on quality companies, stay diversified, and keep your long-term goals in sight. Market environments are always changing, and the key to successful investing is not to predict the future perfectly, but to build a robust strategy that can adapt and thrive no matter what the Fed decides to do next. Stay informed, stay disciplined, and you'll be well positioned to navigate the road ahead. Thank you so much for watching today's analysis. I hope this breakdown was helpful in making sense of this big news. What are your thoughts on the Fed's move? How are you adjusting your investment strategy? Let me know in the comments below. I read every single one. If you found this video valuable, please give it a thumbs up and consider subscribing to the channel for more financial insights. Hit that notification bell so you never miss an update. Thanks again for your time, and I'll see you in the next video.